Hello everyone. Today I'd like to talk about an investment concept called loss aversion bias. So given the fact we're still going through the COVID-19 pandemic, we've seen share markets fall from its record highs on February 14th to the lows of March 23rd, and then have had a very strong V-shaped recovery, especially depending on the sectors that you're invested in. Some have obviously been slower and some have been faster in their recovery. And there's another video that I did previously that sort of covers what happened there. But what I want to talk about today is that through our recent reviews with clients, a certain theme has come up where clients have said to us when we're reviewing their diversified portfolios, Jonathan, when you're looking at potential funds to reallocate to, could you make sure you don't sell the ones that are losing money? And this made me think about why I wanted to create a short video to explain to everyone about this loss aversion bias. Because the only fact that you are relying upon as an investor when you're considering whether or not you are going to sell this particular fund or wanting to sell this fund is based upon your entry price and what the market price is now. And if it's below the price that you got in, you always think, oh, let me wait till my investment goes back up to the price that I invested in and maybe I'll consider selling. But that is not actually the right way to look at the situation. Because if you think about loss aversion bias, this is where an investor succumbs to a loss aversion bias when he or she prefers to pay a higher price for a low risk and low return asset. Thus, he or she consistently prefers to avoid losses over making gains. Most people feel that when you actually make a gain, when you buy a particular investment, let's say you buy a share, they believe that's the way it should be and we should always make money. But inversely, when they're losing money on a particular investment, the psychological aversion to actually crystallizing or actually making that decision to sell and convert what is a paper loss into a real loss is very foreign to them, or it's something that they don't want to actually execute because it causes them too much pain. So the same magnitude of gain versus the same magnitude of loss, people are far more worried about losing money than they are of gaining money. So why don't we have a look at a simple example of loss aversion? So with regards to this example, an investor purchased shares 1 year ago for $1,000. The shares have subsequently fallen a year later and are currently selling for $900. The investor is now confronted with a capital loss of $100. To simplify the example, we assume that there are no taxes or transaction costs, and there is an equal probability of the share price increasing or decreasing in the next year. The investor must now decide whether to realize the loss or hold the shares for another year. So effectively, the choice the investor has is the first one, sell the shares now and actually realize a $100 loss. Or the second choice being hold the shares for one more period or another year with a probability of 50% of it losing another additional $100 or going back up $100 and leaving them to break even. Now what you can see here is that if you objectively consider the $100 that has gone backwards, the $100, if you had made $100, you would think that that's normal. But given the fact it's gone back $100, objectively it is the same $100, but you don't want to sell. And psychologically, you feel that the magnitude of that loss is far bigger versus if you made a $100 gain. The reality is that there is no difference objectively, but our minds don't want to lose. Put it another way, if you knew that the company had no particular potential to outperform into the future again, would you want to continue to invest in that company? The fact of the matter is that if you are relying on no more information than just the current share price versus the price that you paid, then you are not making a rational investment decision. If you invest in a managed fund, not all fund managers are going out, there's not a single fund manager that won't be willing to sell an investment at a loss, solely because of the fact that they know there are changes in circumstances which leads to companies that no longer have the ability to perform, or there are alternative investment opportunities that potentially have higher upside. One famous fund manager told me many years ago that when he builds a portfolio of diversified stocks within his managed fund, what he's trying to do is ensure that 60% of the stocks he makes money, 40% of it he loses money. But he sure hopes that the 60% that make money far outweigh the other 40% that is losing him money. And that is why the only free lunch as an investor is diversification. So that's all for today. Remember, if you liked the video, give it a thumbs up, and remember to subscribe down the bottom to see all our future videos and updates.